Jean Boivin, your words. This is a restart, not a recovery. Jean, what do you mean by that, and why is it important?
This has been, our mantra for the last almost 2 years now, and I think that's pretty crucial and important. We've seen, after stopping the economy for the virus, a restart. We've been in that process for the last few quarters, and it's not a usual recovery. This is not determined, guided by the confidence of the consumers. It's not about investment, sentiment, and animal spirit. It's really about like people being back to being able to back to their activity. Turning on companies. It's about like turning on lights. That can happen very quickly. That's point number one. And point number two, it's a lot easier to restart demand than it is to restart supply. So that creates mismatch. That's where the inflation is coming from. And that's very, very, very different from the type of inflation we've seen like in 2015 or in other cycles. So the diagnostic here, I think, is pretty crucial for what you make of it.
John was focused on the restart line. What I zeroed in on your note is the idea that monetary policy can't simultaneously stabilize inflation and growth. It has to choose between them. Is the Fed, because of its stellar laser focus on inflation right now, at risk of hiking aggressively into weakness, and therefore we're talking in theory about a recession down the line?
So let me just take one thing out of the way, just to be clear, is, it's a restart and a recovery, and that restart doesn't really need any stimulus. It's really about lifting, constraints. So on that front, it makes complete sense to try to start normalizing policy. Doesn't need that stimulus, and that's in line with what they're starting to do, which, I think makes complete sense. I think where it becomes, concerning is when this is motivated or sold as an attempt to tame inflation. And that's a completely different thing, because this inflation, as I mentioned, is really shaped by supply. And we haven't seen that in decades, really that kind of environment. And in an environment like this, you have a choice. You need to decide whether you're going to stabilize inflation or growth. And if you decide to go hard for inflation, it's going to be very costly in terms of growth. You literally have to destroy demand to really tame inflation. So this choice is a lot starker and not warranted, I think, at this stage.
Jean, do you think that that's where the Fed is going, and that we're going to see a material slowdown and even discussion of a recession later this year?
I don't think that's where they're going. If we go by, the cumulative rate of hikes that they're envisioning until 2024, it's still very muted. It's going to be the most muted response in history. So that's in line with what you should be doing in a restart. Lift the foot off the accelerator, but not hit the brake. What I'm concerned about, however, is they're not explicitly or actively, framing it the way I've just talked about. And so that leaves open the door that it could be interpreted as slamming the brake. And the market is certainly primed to do that. And I think this is where we can get, for a while, a pretty bumpy ride. But I think ultimately, even if they were to try to do a slamming the brake, I think they'll be dissuaded pretty quickly. Given the consequences.
Are you more comfortable right now looking outside of the US? I've just heard so many concerns from you right now in the last 5 minutes or so. At the moment, are you more comfortable doing so, looking outside the US?
Concern I've expressed, I think, are really near term. So I think if you take a trading perspective, I think this is more concerning, a lot more surprise and so on. Just to be clear, from an longer term investment perspective, I think it's a bumpy ride, but the fundamentals are not really changed. I think it's remarkable, and I think we should all remind ourselves of that, people now are expecting markets like 5 hikes, right? It took only a couple of months to get there from 0 or even 1. And what changed that? It's not the economic track. It's really like interpretation of what the Fed was saying. So I think that interpretation can change, and ultimately, I think this is, from a long-term perspective, like still constructive. We need to take down risk a bit, but it's constructive even in the U.S. We think emerging markets continue to be an interesting area, an interesting space, and it's useful to look at this area. But within the DM world, no strong preferences for Europe, Japan, or the US at this stage. We're kind of overweight modestly, but equally, I guess, at this stage. I think it's shaped by this restart across the globe.